Howdy, folks. Welcome to Liberty Call. Today is Monday, April 8th, 2024. Hope you are having a fantastical day out there. It is a pretty nice day here in Colorado. A little hazy. We did survive the eclipse, so, everyone was all on pins and needles that the world was going to end or something. Evidently, it hasn't because we're still here for now. So, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. Let's go ahead and jump into today's numbers. Looks like they were pretty flat. Dow Jones was down 0.03%, 11 points, closed at 38,892. The S&P 500 was up 0.01%, closed at 5204. NASDAQ up 0.03%, closed at 16,253. The VIX down 5.12%. It's at 1521. Canada down 0.02. Brazil up 1.76%. And Mexico down 0.16%. In Europe, Germany was up 0.77%, the UK up 0.41%, France up 0.72%, the Netherlands up 0.48%, Spain was down 0.04%, the lone red we can see in Western Europe. Italy was up 0.9%, Switzerland up 0.45%, and Portugal up 0.75%. Russian exchanges both in the green today, the MOEX up 0.74%, the RTSI up 0.63%. And the Asian markets, the Nikkei was up 0.78%, Australia up 0.2%, New Zealand down 0.23%. In China, the Shanghai was down 0.72%, the Shenzhen Component down 1.57%, China A50 down 0.78%, DJ Shanghai down 0.9%, Hang Seng up 0.05%, and the Taiwan weighted up 0.39%. All right, so that is everything for the markets for today. So, like I said, a little weird. Oops, didn't mean to do that. A little odd that the everything was just really hugging the flat line today. So I don't know if traders out there, are they worried? Are they not worried? What's going on? So, anyways, all right, let's get into the weekly economic update. Stocks dropped last week as investors focused on what's next for interest rates after mixed comments from multiple Fed officials. Stocks struggled out of the gate last week, ending Monday and Tuesday in the red on concerns that recent economic data could derail the Fed's plans for short-term rates. Yeah, everyone is hoping that they're going to lower interest rates. Why? Why? If the economy is so good, why you got to lower rates? I thought the economy was good. Which is it? Good, bad, indifferent? The market recovered Wednesday through Thursday morning when weekly jobless claims were better than expected, but stocks fell broadly Thursday afternoon following mixed comments from multiple Fed officials. All three averages ended the day down more than 1% for the first time in a month. On Friday, a strong jobs report gave investors much-needed confidence. The U.S. economy created 303,000 jobs in March, higher than economists' expectations, while unemployment dropped slightly to 3.8%. Markets rallied after the news, but not enough to recoup all of the weekly losses. All right, let's get down here a little further. So what's the scoop? Several Fed officials made speeches last week, including Chair Jerome Powell. In a Wednesday speech at Stanford University, Powell said it was a bumpy path to a soft landing. So now it's no longer just a smooth soft landing. It's a little bumpy. Yeah, until it crashes into the carrier deck. Let's see here. Powell said it was a bump. Yeah, but Fed officials are continuing to look at the long-term trends. Last week, Atlanta Fed President Raphael Bostic suggested one cut. San Francisco Fed President Mary Daly noted no guarantees, and Cleveland's President Loretta Meester said rate cuts may come later this year. Minneapolis President Neil Kashkari rattled markets by suggesting that no cuts may be on the table, followed by Fed Governor Michelle Bowman, who said on Friday that it's possible rates may have to move higher to control inflation. Who's been saying stuff like that? This guy right here. I've been saying that. The flurry of comments comes following the end of the Fed's blackout period. Fed officials are not allowed to make public comments except for very narrow windows during the year. All right, economic data this week. Tuesday, we have the NFIB Small Business Optimism Index. Wednesday, the Consumer Price Index, the FOMC Minutes. That'll help us sleep later in the week. And the EIA Petroleum Status and Treasury Statement. Thursday is Jobless Claims and the Producer Price Index Final, the Fed Balance Sheet, and the EIA Natural Gas Report. And Friday, Imports and Export Prices and Consumer Sentiment. Bunch of companies reporting earnings this week. Tuesday is Albertsons. Wednesday is Delta Airlines. Thursday, Progressive Corporation, Infosys, and Constellation Brands. Friday is JP Morgan, Wells Fargo, BlackRock, Citigroup, and State Street Corporation. All right, so that is everything in the news it's good to talk about today. All right, let's get to the market recap. U.S. stocks flat on cautious trading ahead of key inflation data and earnings. U.S. stocks traded cautiously on Monday, hovering just above the flat line as investors awaited key economic data, the start of the first quarter earnings season, and the start of the first quarter earnings season. Attention was particularly focused on the upcoming release of the March Consumer Price Index, expected to show a slight cooling to 3.7% annual pace compared to the previous month's 3.8%. This reading, along with other global economic indicators such as the Bank of Canada's decision and Chinese inflation data, could influence market sentiment. All right. Investors also awaited the release of the FOMC meeting minutes for March, which could provide insights into potential interest rate cuts and the Federal Reserve's plans regarding its quantitative tightening program. Traders currently estimate a 51% chance of a 25 basis point rate cut in June. I doubt it. Additionally, the start of the first quarter earnings season with major banks like JP Morgan, Chase, Citigroup, and Wells Fargo are set to report earnings, added to market anticipation. Investors were keen to see if corporate profits could justify recent stock market gains. In individual stock movements, Boeing faced a 0.7% decline following a reported malfunction issue involving a Southwest Airlines aircraft, while Tesla rebounded 5% after announcing plans to unveil its robo-taxi design. Taiwan Semiconductor's Manufacturing's Arizona unit secured significant funding under the CHIPS and Science Act, bolstering its stock. Meanwhile, energy stocks remained flat as oil prices dropped amid hopes of a ceasefire in the Israel-Hamas conflict. Wouldn't hold my breath. Alleviated concerns of supply disruptions. Talks between Israel and Hamas ahead of the EID holidays contributed to easing tensions in the oil-rich Middle East. Notably, APA Corporation, Phillips 66, and Schlumberger were among the energy sector's notable losers. All right, so people are still on pins and needles because of Israel and Hamas, and then you got Israel and Iran that are at odds right now. So I mean, again, like I've said before, there seems to be a problem with the Israelis. They don't make good neighbors. They seem to piss off everyone around them. So not really shocking. All right, next up from Zero Hedge, this article is titled "Why U.S. Public Debt is Unsustainable and Destroying the Middle Class." This article challenges the prevailing notion that public debt is sustainable and indefinite, highlighting the dangers of excessive debt accumulation and its impact on economic health, contrary to the belief that a country's fiscal imbalances can persist without consequences. The author argues that unsustainable debt burdens eventually lead to detrimental outcomes, drawing parallels with individuals' unhealthy eating habits, and the article contends that just because negative consequences have not yet materialized does not mean the behavior is sustainable. Yeah, kind of like those fat people who claim that you can be healthy at any size and you're 400 pounds and they can't get up and walk around. They have to use little scooters at the grocery store. Yeah, you're not healthy. You're probably going to croak. Let's see here. The piece delves into the mechanisms by which governments accumulate debt, often coercively imposing it on the financial system and the private sector. Money printing. It warns against the normalization of rising debt levels, emphasizing the adverse effects on economic growth, real wages, and productivity. The author criticizes the tendency to overlook these warning signs, attributing it to a complacent mindset that ignores the gradual erosion of the middle class and small businesses. Yeah, who cares about them? Furthermore, the article underscores the role of central banks in perpetuating unsustainable debt through artificial currency creation, which disproportionately benefits the government while harming savers and the productive economy. It argues that government debt only becomes a reserve asset when the private sector perceives the issuer's solvency as reliable. However, when public debt is forced upon the economy without regard for its productive capacity, it undermines the foundation of wealth and prosperity. The piece concludes by cautioning against the belief that unsustainable debt levels can persist indefinitely. It highlights indicators such as diminishing GDP growth, erosion of purchasing power, and declining productive investment as red flags of an impending economic downturn. Ultimately, it advocates for fiscal prudence and warns against the long-term consequences of neglecting unsustainable debt burdens. I think we're past the point of no return, personally. I'm just kind of curious to see what's going to happen. I mean, is it the federal government going to collapse? Is the dollar going to collapse? Is it all of them going to collapse? I don't think that the collapse of the republic is going to be a civil issue. I think it's going to be a financial issue, personally. But again, I'm in the financial world, so that's what I pay most attention to. Really don't pay a lot of attention to the blue-haired weirdos. But anyways, all right, one last article here comes from our buddies over at First Trust, Mr. Brian Westbury. This week's article is the Fed tight or not? And what they mean by that is it restrictive monetary policy or is it loose? This article commences with a recounting of a contentious foul called during a highly watched women's college basketball game between UConn and the University of Iowa, which continues to fuel debate. I didn't watch it because girls basketball bores me. Transitioning from sports to economics, it delves into the ongoing discourse surrounding the Federal Reserve's monetary policy, specifically questioning whether it is genuinely as tight as often portrayed. Mr. Westbury introduces a two-part test to gauge the tightness of the monetary policy. First, whether the economy has weakened below trend growth, indicated by falling GDP or rising unemployment. And second, whether inflation has persistently declined. Despite traditional measures indicating tightness, the article argues that recent economic indicators suggest otherwise. Examining current economic metrics, the piece notes that real GDP growth remains close to long-term average, with unemployment still below 4%. While CPI inflation experienced a temporary drop from supply chain-induced spike, recent data indicates a cessation in its decline, with consumer prices projected to rise again. Not good. Despite these fluctuations, both real growth and inflation portrayed little impact from supposed Fed tightening. The article explores various metrics of monetary policy, including the M2 money supply and the slope of the yield curve, suggesting that while they may traditionally signal tightness, their implications are currently ambiguous. It compares current interest rates to nominal GDP growth, revealing a discrepancy that challenges the conventional narrative of monetary policy tightness. Ultimately, the article posits that monetary policy might not be as tight as commonly believed, potentially leading to prolonged inflation and higher short-term rates than anticipated. It warns of impending economic challenges contrary to prevailing investor expectations, and concludes with a metaphorical analogy likening economic predictions to navigating a basketball game, implying the inherent difficulty despite the available time. This comparison underscores the complexity of addressing and predicting economic trends amidst ongoing debates and fluctuating indicators. Yep. There's a whole lot out there, and it doesn't look real good, but it could. I mean, again, we could all just be wrong, and the economy could just be smooth and sail into the next year and beyond without any problems. I mean, Biden could be just steering the ship perfectly. I mean, hey, he could be just the best president we've ever had. I doubt it, but it's possible. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. And again, glad we survived the eclipse. Bye-bye.